NIO Inc. ADR, New York Stock Exchange NIO. Current status, market closed, closing price 5.46 USD. Intraday movement minus 0.040, minus 0.73%. The markets have officially closed, and NIO stock has finished the session sitting at exactly 5.46 USD, registering a decline of roughly 0.73% for the day. While a movement of less than 1% might appear stable on a surface-level ticker, the reality underneath this price action is anything but calm. If you are watching this stock through your Robinhood app or tracking the ticks on interactive brokers' trading screens, you are likely feeling a very specific type of tension right now, the tension of a coiled spring that refuses to release. The expectation for NIO, particularly after its recent Q3 earnings print, was a decisive breakout or a catastrophic breakdown. The expectation was that the launch of the Onvo sub-brand and the Firefly project would immediately ignite a rally, validating the years of heavy CapEx spending. The reality, however, is far more nuanced and frankly more frustrating for the average retail holder. We are seeing a classic battle where the headline numbers, a revenue miss, are masking a fundamental shift in the company's operational efficiency that the market has not yet fully priced in. While the bears scream about cash burn, the gross margins just jumped from near 10% to 14.7%, a massive signal that the price war damage is stabilizing. This disconnect between the bearish narrative of dead money and the bullish reality of improving unit economics is where we need to focus our attention today. When you look at the intraday charts, you see a stock that is being heavily compressed. It's hovering just above the psychological support of $5.30 to $5.50. This is a zone that technical analysts would call a do-or-die level. If you are managing your own funds via Schwab Intelligent Portfolios or active trading on SoFi Invest, you know that when a high beta stock like NIO compresses this tightly after a major news event like earnings, it usually signals a massive move is coming. The volume today was respectable but not explosive, suggesting that the big institutional players are currently in a holding pattern, waiting to see if the $5.50 floor holds through the rest of the week. This hesitation is likely due to the mixed signals from the broader Chinese EV sector. While Tesla stock has been enjoying a renewed wave of optimism globally due to autonomy promises, NIO was fighting a different war, a war of infrastructure and hardware scaling. Investors are currently paralyzed by the fear of further US and EU tariffs, which we will discuss later, versus the hope of domestic stimulus in China. Let's talk about that expectation versus reality dynamic in the context of the recent Q3 earnings, because this is the engine driving the current price. The expectation going into the report was that NIO would show massive revenue growth but terrible margins due to the ongoing price wars in China. The reality was actually the inverse. Revenue came in at $3.06 billion, which was a slight miss against the aggressive analyst estimates. However, the loss per share was narrower than expected, at 21 cents, compared to the forecasted 24 cents. This is crucial. Why? Because for years, the knock on NIO has been that it loses money on every car it sells. The fact that vehicle margins expanded to nearly 15% in a quarter where competitors were slashing prices is a massive deviation from the bearish thesis. If you are using Fidelity wealth management research tools or reading reports from Fidelity brokerage analysts, you will often see margin compression listed as the #1 risk for Chinese ADRs. NIO just bucked that trend. This margin expansion suggests that their cost-cutting measures and the efficiency of the NT 2.0 platform are actually working. Yet the stock is down 0.73% today. Why? Because the market is forward-looking and the guidance for Q4, projecting 120,000 to 125,000 deliveries, was viewed as conservative. The market wanted a blowout forecast to justify the valuation, and instead they got a prudent, realistic outlook. This disappointment is what is keeping the lid on the stock price at $5.46. We need to look closer at who is actually holding the bag here and who is buying. Institutional tracking data has shown some very fascinating divergence recently. While some major funds like UBS have reduced their exposure, we have seen massive aggressive buying from quant firms like Jane Street and Aspects Management. This is the kind of data you might miss if you are just casually glancing at a Robinhood crypto or stock feed, but it is vital. When smart money quant funds start loading up on a depressed asset while traditional long-only funds exit, it often signals a bottoming process. These firms are likely looking at the arbitrage opportunity and the sheer undervaluation of NIO's cash position relative to its market cap. The disparity is striking. Retail investors, many of whom use online investing platforms to manage their own individual brokerage accounts, are often the ones selling in these moments of stagnation, worn down by the volatility, while the algos absorb the liquidity. Now, I want you to take a second and actually engage with this. Comment below with your average buy price for NIO. Are you one of the OGs holding from the $40 and $50 days? Or did you enter recently near these $5 lows? And more importantly, do you think the Onvo brand will actually cannibalize the main NIO brand? Or is it the volume driver they need? I want to see the sentiment in the comments because the retail sentiment on this stock is usually a leading indicator of short-term volatility. Let's shift gears to the product execution because this is where the Tesla of China comparison both shines and falls apart. When people look for investment help or search for investing sites to pick EV stocks, they almost always land on Tesla stock first, then look for the next one. NIO has always positioned itself as that premium alternative. The launch of the Onvo L60 is the most critical moment in the company's history since the 2020 bailout. The Onvo brand is targeting the mass market, specifically the Tesla Model Y demographic. The early numbers are promising, with deliveries contributing significantly to that Q3 bump. However, the risk here is brand dilution. NIO has spent years building a lifestyle brand with NIO houses and premium service. Launching a cheaper sub-brand is a dangerous tightrope walk. If Onvo succeeds, NIO becomes a mass market giant with premium margins. If it fails, or if the margins on Onvo are too thin, it could drag the whole ship down. The market's reaction today, that slight red close, tells us that investors are still in show-me mode. They don't just want to hear about Onvo orders, they want to see Onvo profitability. There is also the massive elephant in the room, geopolitics and macroeconomics. You cannot trade NIO in a vacuum. If you are sitting at home managing your Schwab Intelligent portfolios, you have to understand that holding NIO is partly a bet on the Chinese macroeconomy. The recent stimulus packages announced by Beijing were expected to be a bazooka that would reignite consumer spending. The reality has been more like a water pistol. The stimulus has been piecemeal, largely focused on debt restructuring rather than direct checks to consumers. This has dampened the excitement for big-ticket items like premium EVs. Furthermore, the tariffs situation is grim. The European Union has moved forward with provisional tariffs on Chinese EVs, and with the political climate in the U.S. shifting following the election, the chances of NIO ever entering the U.S. market meaningfully are near zero for the next 4 years. This limits their total addressable market, TAM. The Firefly project, which is their mini EV designed for Europe, faces a 20 to 30% price hike immediately upon arrival. These tariffs destroy the value proposition. The market knows this. That is why the stock struggles to regain the $6 or $7 handle. The expectation was global conquest. The reality is a fortress China strategy with limited export potential. But we must look at the technology moat. Battery swapping. This is the one factor bears consistently underestimate. While Tesla stock bulls scream about superchargers, NIO has quietly built thousands of swap stations. This is not just about charging speed, it is about grid stabilization and battery degradation management. By separating the battery from the car, they lower the upfront purchase price, allowing them to compete with cheaper ICE vehicles. In a deflationary environment in China, where consumers are penny pinching, the ability to buy a car without the battery and pay a monthly sub is a massive psychological sales lever. It lowers the barrier to entry. If you are looking to invest online in the EV space, you have to ask yourself, does any other company have a moat like this? No. It is capital intensive, yes, which hurts the balance sheet today, but it creates a sticky ecosystem. Once a user is in the NIO battery swap network, they are very unlikely to switch to a standard plug-in EV. It is the same ecosystem lock-in that makes Apple stock so formidable. Let's look deeper into the